All right, so we are recording this. Um,
Okay.
okay. Good morning, everybody. I'm glad to see people here. At least your names. Feel free to, to start your video if you want. If you're on a computer or using the app on a smartphone or a smart device, then we can see your lovely face. We'd love that. There's kind of a smaller number, so I think I know Nadia and Daniel will be happy to take questions. You can unmute. You can put something in the chat. We'll try to monitor the chat to keep that going. I had a couple things I wanted to mention just about the association. We were kind of getting around this, but people are always asking, well, when are we going to start meetings in person? So we have had a couple committee meetings in person, and what we're doing is offering hybrid meetings, so that those that choose to come can, and those that don't can still do it this way. We have a Cisco room kit that actually we did our first class on yesterday, or class with yesterday. This has multiple cameras, audience microphone, and it worked great. We did a 3-hour core law class with Patty Ketchum was the instructor. I think we have 45 or 50 people online. So we're going to do that. We're going to limit kind of limit the numbers in person for now. Leon County is still under mask ordinance, so we have no option as a business but to adhere to that mask ordinance, which does make it a challenge when you're sitting in a class for 3 hours or 1 hour, 2 hour, whatever it is. So we are moving that way. Beginning next month, our CE classes will all be, well, not all, the ones that we have instructors in town or that come here, we'll offer them as a hybrid. There'll still be some that'll be offered, just totally through either WebEx or Zoom. And so we're looking forward to that. We're looking forward to having people in the office. We have a challenge with meetings where we don't have registrations because we don't know how many people are going to show up. And we don't want to have an issue where we have to turn people away. So that's a little bit of a challenge that as the months go on, I'm sure we'll be able to overcome that. For those of you that are interested, and I've been posting some stuff, if you're on our Facebook group, or I've also sent some stuff directly to the commercial listserv. NAR has great information about like the COVID relief package that was just approved or actually passed yesterday. I'm not sure if the president has signed it yet, but I don't think there'll be a problem with that. So if you need information about that, you want to see what's in it, that can help you or your customers or your clients. Realtor is the website, and that's a great option. We're recording this session, and so we'll have the recording available for people if they want it. Those people that couldn't attend. And with that, I want to introduce our commercial director, Stuart Proctor, and thank him for organizing this. That's Stuart.
Stephen, thank you. I'm not sure how much organizing I did, except make a few phone calls. We appreciate everybody tuning in this morning. It's been a challenging 12 months to try to have regular programming for the commercial brokerage, commercial council. So appreciate everybody that's here this morning. We've got Nadia, Batey, and Daniel Roccanti from James Moore and Company, CPAs. They are going to give us a tax update. They are both very experienced and members of their firm's real estate services team, experts in taxation and corporate entities and all that fun stuff. So if you have questions, raise your hand or post a question up, and with that, we'll turn it over to Nadia and Daniel, and look forward to what y'all have to say.
Awesome. Thanks, Stuart. We really appreciate this opportunity to get in front of you guys and just share some information that we've gained over the years. I'm going to share my screen, but usually when we do presentations, I love it to be interactive. So if you do have any questions, any comments, raise your hand, put it in the chat, and that's where we usually learn the most, is from each other or just asking questions and kind of having those discussions. So feel free to do that. Let me make sure that this is going to work on my end. Can everybody see my screen?
Yes.
Awesome.
Yeah.
Okay, great.
It's your whole screen, Nadia, so
Oh.
it's small.
Let me make it bigger here. That help?
That's better.
Awesome. Okay. All right. So 2021 real estate outlook, financial moves to consider. I think Stuart said it, or somebody did previously, that 2020 was a rough year for real estate and ended up being a pretty decent year. And we're hoping that it's going to just continue in the future. I know last March we were sitting here shutting down our office, going remote, and wondering, oh my goodness, 6 weeks into that, it was like, what's going to happen to commercial real estate going forward? It's been somewhat resilient, so that's a good outlook for the future. Let's see here. So as Stuart mentioned, I think it was Stuart that mentioned it, it might have been Steve, the American Rescue Plan Act was passed yesterday by the House. It was passed by the House, went to the Senate, had to go back to the House to get passed again because of some revisions. And I assume that President Biden is going to sign this bill today. And it will be enacted after today or sometime this week. But we're going to let Daniel kind of go into some of the details that were in this plan and how it affects us. We've not dove into every word, but just kind of hit the highlights of what's included. Daniel.
Thanks, Nadia. So like Nadia said, this is actually a pretty big bill, so we're just kind of going over the highlights here. There's actually a lot to talk about even in this bill coming up. So the one that probably everyone's heard about the most is $1,400 direct payments, okay? And if Biden signs this today, we expect these payments probably to go out in the next week or two, as long as you got direct deposits set up with the IRS. There's a few things that change this time around. So the first is that you get $1,400 for each individual and for each qualifying dependent. Qualifying dependent has changed this time around to include college age kids and also adult dependents. So before, those were excluded, so you could actually get more payments this time around because the dependents expanded the definition. The threshold to receive these payments for single is $75,000 and phases out at $80,000. That is very quick. In the old ones, it would phase out at around $100,000. So it's phasing out a lot quicker this time around. And if you're married filing jointly, it's double that. It's $150,000, phasing out at $160,000. The IRS will be using your most recent tax return to determine if you were eligible for these payments. So if you have not filed your 2020 tax return, they will be using your 2019 tax return. And technically, this is a 2021 advanced tax credit. So if you are over these thresholds for 2020, but you are not for 2019, we highly recommend that you don't file until after you receive your payments, because this is kind of a win-win scenario where if you receive the payments, but you shouldn't have based on your tax returns, you don't have to pay it back. But if you should have gotten it, but you didn't get it when you file your 2021 tax return, you'll get it as a tax credit. Next big thing that passed is unemployment benefits. It extended the $300 weekly additional federal funding for anyone who is on unemployment to September 6th. And then what was a really huge thing they did is the first $10,200 of 2020 unemployment benefits is not subject to tax anymore if you're making less than $150,000 per household. So if you already filed your tax return for 2020 and you had picked up the $10,000 on your as taxable income, you're going to be required to amend to get that taxes back. Next page, Nadia. Another big thing in this plan is the child tax credit increase. Now, this is only temporarily for 1 year for 2021, but it increases it to $3,600 for each child under 6, $3,000 for other qualifying children. And one thing that is really, really unique for this is that even though this credit is for 2021, they are going to start doing advanced periodic payments for this during the calendar year. Okay, so instead of getting this credit when you file your 2021 tax return, You actually are going to start getting these payments in July through December. They're going to start paying them out in monthly payments. And they're going to create an online portal where you can basically go on and update your information so that the IRS can have more accurate information and hand out your payments, providing on what your actual what you would receive based on there. Now, do know that you will have to reconcile these payments when you file your 2021 tax return. So if you go in there and ask for a lot of money and then you weren't supposed to get it, you will have to pay it back on your taxes. These credits do phase out a lot quicker than the normal tax credit. They start phasing out at 150 for married and filing joint, and then 75,000 for single. And remember, this is only temporary. This is only for 2021. Under this current law, it would still go back to the old tax credit of $2,000 per child once in 2022. Another interesting thing they did in this plan is that any discharged student loan debt would be excluded from taxable income in 2021 through 2025. Now, this bill does not actually discharge any student debt. It's just saying that if it ever happens, it will not be taxable. So obviously they're trying to do some big things about canceling student debt in the future, and this is just a setup for it. This also extended a few previous things, like the employer retention credit, extended this through the end of the year. So it was originally planned to end at the end of June this year. Now that goes through the end of the year. This is a payroll credit, so this would be taken on your payroll tax returns. The last is the coronavirus paid leave credit. They extended this also to the end of September. And so this is anyone who is out because of the coronavirus, basically. They also added that if you're out because of getting vaccinated, this can also be in it. And this credit is available to self-employed individuals. So if you're self-employed and you cannot work because something coronavirus related, then you can also get this tax credit. You can take it on your tax return. Next page, Nadia. We're going to jump back a little bit in time to the Consolidated Appropriations Act. So this was the budget that passed over Christmas time. Just going to quickly go over a few things that happened there. This one, they had $600 direct payments. So the $600 here plus the $1,400 that we just got is supposed to meet your $2,000 payments that the Democrats promised. Another really big thing they did here that was awesome is that starting in 2021, 100% deduction for business meals, as long as they're provided by a restaurant. That definition is pretty broad, but basically take full advantage of it. They want you to go out to eat. It doesn't have to be going out to eat. You can get takeout or anything as long as it's considered a business meal. You're getting 100%, so that's an increase from 50%. To also increase charitable giving, they're giving you a $300, $600 charitable contribution deduction for non-itemizers. So even if you don't itemize, you will still get a $300, $600 deduction as long as you got charitable contributions. This also provided us with a second round of PPP, which Nadia will go into a lot more detail later. And then it clarified some of the PPP expenses deductibility. And this basically what this means is that if you used any of your PPP expenses for forgiveness, we weren't sure if they would be deductible or not. This clarifies that they are deductible. In essence, this makes your PPP forgiveness not taxable, which is a great win for everyone who got PPP. And then also this made 179D, the energy efficient tax deduction, permanent going forward. And we will talk more in detail onto that. Next is, I'm going to give it back to Nadia, who's going to kind of go into what the future might look like now with Biden as president.
Yeah. So one of the questions that we get constantly right now is, should I sell something? Should I realize this income now? Should I wait and realize it? What are my taxes going to be in the future? And unfortunately, we don't have a crystal ball, but because of some laws that have passed recently over the last 3 months, and then what Joe Biden has ran his whole campaign on, we can kind of get an idea of what some of those changes will be, and especially how they're going to impact real estate investors. So we're going to talk about the income tax changes, potential estate tax issues, and then the SALT deductions. and then how quickly we should be prepared to act, and that's probably now. One of the most common questions that I get is, hey, I'm a real estate investor. Should I recognize the gain on the sale of this property, or should I do a 1031 exchange? And even regardless of what that decision is, what you decide to do is to start thinking about the impact over the next 4 years, as we know the tax laws are going to change. That's the one thing that will happen, is that we will have change. Not exactly sure what that change is going to exactly look like. So during the election, Biden came out with kind of what his vision of changes to the tax law would be. And he ran on increasing individual tax rates from 37%, what they are currently, to 39.6%. Now, there's a magic number that we're going to see in all this, and it's 400,000. They have drawn the line in the sand and said anybody who makes 400,000 is going to be subject to some of these changes. Anybody who's under that potentially won't be. So it will be interesting to kind of see how that shakes out, if that $400,000 actually stands the test of time, or if they lower it or potentially increase it. There's going to have to be some bipartisan support to get any of these changes on the books. So one of the other things that he wants to do, or he ran on, is capping itemized deductions. So if you're a large charitable giver, you have a lot of interest expense deduction. We're capped on the real estate for right now, but he's saying, hey, we're going to limit those benefits that you get when you itemize. And again, we're at that magic number of $400,000. Qualified business income deduction. This was the 20% deduction that happened with the TCJA Act under Trump. And so they're wanting to limit that again to individuals over $400,000. Expanding the earned income tax credit. I'm pretty sure this is going to happen. We're kind of seeing this historically now with the expansion of the child tax credit, of testing those waters. And then, of course, creating an $8,000 tax credit, but they're wanting to make it permanent for individuals below that $125,000, but being phased out once you get to that $400,000. And I think the interesting thing is the expansion of this child tax credit with the bill that was signed yesterday by the House is kind of the introduction to this, of saying, hey, we're really wanting to beef this up and make it permanent. And I'm sure that they're going to probably address that sooner rather than later. One of the things that would affect real estate is first-time homebuyer credits. We had this several years ago. I'm sure everybody remembers that, but it looks like that potentially will come back. So this is a benefit if this actually passes to the real estate industry. What is it going to do to prices going forward? I have no idea, but there is a potential that we'll have this first-time homebuyer credit of $15,000. If you remember from the past, part of that credit didn't have to be paid back, and part of it had to be paid back over a period of like 10 years. Time will tell kind of how this credit will evolve and what it will look like at that point in time, but that's a good one for the real estate market. Renter credit to assist low-income individuals. So there's a lot of talk about affordable housing. We hear it all the time, and there is an issue with, potential affordable housing. I think we're going to see a lot of legislation, tax incentives, credits around affordable housing, and this was one of the things that was proposed when he was running for office. And then the big one, which is what we're going to have to really, really pay our real estate lobbyists to do a good job, real estate boards, whatever it is, whatever organizations represent the real estate market, is the elimination of 1031 exchanges. And this is just to balance the budget for anyone making over $400,000. It would be a detriment to the real estate industry in general. This is a huge tax benefit for real estate investors. And if this is eliminated, it would have a definite impact on the real estate market in general. So as this is talked about, just really let's talk to our representatives, anybody who represents the industry, and say, hey, we really need to fight this one. The other big one that would affect the real estate industry is capital gain rates and deferrals. And so this is one that I personally have thought was going to be coming down the pipeline eventually. What's a great way to generate some tax revenue is to eliminate capital gain rates. And so right now, depending on your income, capital gain rates are anywhere from 0 to 20%. And then there's an additional 3.8% Medicare tax that you would potentially be subject to. So we're talking 0 to 23.8%. Well, under Biden's plan, he would like to increase capital gain and qualified dividend rates to the ordinary rates, okay? But here again, what is that income level? It was potentially set at $1 million. We keep seeing that $400,000. Again, we'll just have to kind of wait and see. But these are the questions that we're getting, especially when it comes to 1031 and capital gains. Do I sell my property now? Do I pay the capital gains at the 20 to 23% now? Or is the tax law going to change in the future and I'm going to potentially be subject to ordinary gain rates? And this is, we're not really sure. Or do I do a 1031 now, continue to defer that gain, and then fall under the rules that we have for 2021 for 1031s if 1031s ultimately go away. So these are kind of the planning strategies that we are going over with clients right now. And it all comes back to, what is your end goal? Are you wanting to sell this property in the next 5 years? Is this a property that you're wanting to let your children or your estate inherit? So there's a lot of facts that go into the analysis of determining, do we pay the capital gains now? Do we defer it? Do we do a 1031? So there's a lot of things that we look at when analyzing that. Opportunity zone reform. Opportunity zones were in the news a lot. We've seen some funds, some people invest in them. I don't think that they've taken off the way that they were intended, but there's a ton of tax benefits if your property that you're developing, you're potentially purchasing, is in an opportunity zone. But there are specific rules to the opportunity zone, and you really need to consult your tax advisor before purchasing that property, because there's certain checkboxes that you have to meet, make sure that that entity is set up in the proper LLC that would qualify for an opportunity zone. You don't want to mix it with other properties, but it has some great tax benefits if you do qualify. And then some potential individual estate provisions, eliminating the tax-free step-up of estate assets. And this is huge for estate tax planning purposes, is because currently when a person passes away, you get a step up in basis to the fair market value at the time of their death. Well, again, to kind of balance the budget, increase some tax revenues, there's been talk of potentially eliminating that tax-free step up in basis, or limiting it to people under a certain income threshold. So we'll just kind of have to wait and see. But if this passes and you have a taxable estate, it's going to be imperative that you really do some estate planning around some of these provisions, these potential provisions. These are not law yet. This is, again, potential law changes in the future. So another potential change is Social Security payroll tax. So right now, Social Security is maxed out at $137,000, except for the 2.9%. But if the Biden administration gets their way, Social Security would be all wages up to $400,000 would be subject to Social Security payroll tax. So that's a big tax on those who are self-employed. Real estate agents, of course, you're self-employed. It's the #1 tax that most real estate agents pay. And so your earnings up to $400,000 would potentially be subject to Social Security tax. Automatic 401k plans, and then tax credits to start or continue retirement plans. Corporate tax rates, potentially raising that to 28%. This has also been in the news a lot lately regarding increases in corporate income tax. And then the big one is imposing a 15% minimum corporate tax for companies reporting book income over net income over 100 million. And so you've seen headlines of, Amazon doesn't pay any tax. These large corporations don't pay any tax. Well, they're taking advantage of the tax laws that are on the books. And there's a timing difference between their book income and their taxable income. And that's trying to say, hey, we know you're taking advantage of these tax laws, but we still think you should pay a minimum corporate tax. And that's potentially what that would do. And then, of course, the international tax, which is a big subject also, but potentially imposing a 21% GILTI tax on foreign profits. So potentially a lot of changes in the future. Again, nothing has passed. This is just what Biden has run on. And we know that it's going to be some version of this in the future. But again, it's going to have to get some bipartisan support to come into play. All right. We're going to go over PPP a little bit. I'm not going to go into a ton of detail because I think everybody is interested. Already knows the rules, but there have been a couple of changes in the last, 4 weeks that we thought we would touch on, and then talk about some cash creation options. And this is a big one for real estate clients and other businesses, is that during last year, we kind of evaluated where a lot of our clients were and said, okay, there's some opportunity here to create some cash in your business, and the cash in the form of tax refunds. And I think we're going to go into QIP, NOL carrybacks, R&D credits, and accrual to cash and adjustments and inventory write-offs. But what happened under last year is they said, hey, we're going to temporarily release NOL carrybacks. And so under the TCJA Act, what happened was that if you had a net operating loss for the year, you were no longer allowed to carry that NOL back. You had to carry it forward, and then you were limited to only 85% of it if you carried it forward. Well, when the pandemic hit, they said, okay, we're going to temporarily release this to get some cash into the economy. And so it created an opportunity that if you had an NOL in 19 or 18, you could carry that back to a previous year and get a tax refund. And so a lot of amended returns were filed and put cash into the pockets of businesses at that time. R&D credits, if you do any type of manufacturing or know a business that does manufacturing, software development, there's a ton of industries that qualify for R&D credits. And even if it's not if you don't owe tax, there's actually a portion of it that you can get a refund on payroll taxes. So that was sometimes can be a pretty cool credit, and people qualify for it when they don't even realize they qualify for it. Accrual to cash. So this was a big one too, is that the rules changed to where you could actually file on a cash basis if you had less than $25 million of gross receipts. And so by changing from an accrual to cash basis, it could actually create a loss or create a deduction on your income tax return for that year. And so if you currently report on an accrual basis, you really need to evaluate that and say, hey, does it make sense for us to transition to a cash basis? And it's just a form you file and then make the adjustments on your tax return. And then another big one was inventory write-off. For those industries that have inventory on their books, under these rules, if you're under that 25 million threshold, you can potentially write off that inventory and take a deduction in that 1 year, again, freeing up cash in the form of a tax refund. There are specific rules if you have audited financials and things like that, but for a lot of industries, we could just write that off. Real estate is going to be a little bit difficult. You probably aren't going to qualify for that inventory write-off of real estate, but other industries would. Okay, and then other items to talk about is the eviction foreclosure moratoriums. So this is an interesting topic because we currently do have an eviction and foreclosure moratorium, I think until April, the end of April, and that was extended by Biden. I think a lot of people know that it doesn't have a lot of teeth. That actually there was a case in the Texas Supreme Court that got settled maybe a week ago, and Texas said, hey, CDC, you can't force landlords to not evict or not foreclose on properties. But we do have this moratorium. In fact, it will probably be hopefully lifted at the end of April. The rental delinquency rate, the last time I checked the percentage, that it was about 6%, up from about 4% in 2019 to about 6.2% in December 2020. And those rates are a little bit lower than what I thought. I would have expected them to be a lot higher, but there's been a lot of money for rental assistance out there, I think, to help people continue to pay their rent. So the future will hold on this, and we'll kind of see what happens going forward. And then interest rates. This is another big topic. We've had historically low interest rates, which have really fueled the housing market, the real estate market. And we've seen those interest rates kind of creep up from a mortgage standpoint. But what will the Federal Reserve do? I don't know. I think it's anticipated that we will probably see an increase in interest rates over the next year. What that increase will be, who knows, depending on the economy. And what happens with our recovery will kind of dictate probably those interest rates. And then, of course, the whole inflation piece of that. And then focus on renewable energy. And we're going to talk about some housing credits in a moment. This is a big subject for this administration, is renewable energy, sustainability. And that's going to really dictate the future housing market and potential construction on new homes. Are those homes energy efficient? What type of credit can we get for those homes? Are they sustainable? I think the younger people that are entering the housing market, this is a really important characteristic for them when they're purchasing a home. And then the whole affordable housing. And part of this affordable housing is in the last bill that was passed. There was $20 billion, I think, or no, in the current bill that was passed, set aside for rental assistance. The problem is that this isn't going to the landlords. The landlords actually don't qualify for any of this new assistance. It's being given out to the local governments, who then give out the money in the form of rent assistance. But I think that will continue. I think that we'll potentially have some additional programs around affordable housing going forward to help people with that rental assistance on a permanent basis. Something outside of Section 8, we'll kind of see how that develops, but this administration has said that it's an important priority of theirs is to help with affordable housing. All right, so PPP2. Oh yeah, does somebody have a question?
I got a question. Yeah, referring back to your predictions. Elizabeth Warren had proposed the possibility of a wealth tax. Any feedback on that? Have you read that proposal of hers?
Yes.
And what I'm looking for is what are they looking for? A $50 million net worth, or is it more of a $2 million net worth?
Mm-hmm. So does anybody remember the Florida intangible tax? I think it was the intangible tax years ago. And when I first got into the public accounting world, Florida had a similar tax to this. And it was ultimately that if your investments were over a certain amount, there was this low, and it was mainly publicly traded investments, you had to pay this intangible tax in the state of Florida on your investments. And Florida did away with that because it wasn't a huge income generator, and it was very, very subjective. And I think that's the issue with this wealth tax, is that, number one, how do you evaluate the fair market value of these assets? When it could be real estate, it could be options, stock, cash, whatever it may be. So that's the first hurdle is, okay, how do we evaluate this? Because if they're wanting to do a fair market value on my real estate, that's held in a partnership with, 10 other investors, well, it's going to be at a discounted rate, not actual probably what you would sell it for. And then what's the threshold? And then what's the percentage? And if you've read any articles on this wealth tax, there have been other countries that have tried to put it into service, or trying to tax people's percentage of their wealth, and it doesn't generate much income because, again, it's very, very subjective. And so from what I understand is they are really looking at very, very high net worth individuals. I've read some articles where it could be around that $50 million threshold, and then some that it could be much higher, hundreds of millions to the $1 billion threshold. And I think the state of Washington actually has instituted this tax, and it affects like 4 people. It's just crazy. So I'm like, okay, well, you're actually just taxing 4 people in your state to generate what percentage of revenue or what amount of revenue. I don't know if this is going to get any traction. And because historically in the United States, we have not done value taxes except for real estate taxes. I mean, there's some taxes that we do assess at a local or state level on valuations, but it's going to be really, really hard to get traction on a national level. Again, they don't have the votes in the Senate. They're going to have to get some bipartisan support. And I think there's other areas that they're going to concentrate on getting that support and not this wealth tax. Does that answer your question a little bit?
Yeah, that's great. One other question while we're back to looking forward. So we do expect changes. At what point is it too late? Capital gains are still at the old rates, the Trump rates. If we sold something today, if we contracted today, are we in a safe harbor because we contracted today, even though it may not close till the end of the year? Or when do you think that at-risk date is?
So this is my opinion. So I just want to make sure that everybody's aware that this is my opinion. I think that 2021 is a freebie year. Okay. Historically, there have been some tax changes that have happened retroactively, but it's been very rare. I think that any tax changes that we will have hopefully fair warning about. We're going to hear the bills come up for discussion, for vote. The committees have to get together. I mean, there's going to be a ton of warning. It's not going to happen in 2021, is my opinion. 2022, 2023 is probably fair game, but this is going to be it's going to be discussed at every single level, including our lobbyists, any of those individuals who represent the different industries that we're in. So it won't be a surprise, and I'm 99% sure that it's not going to be retroactive. It will just be enforced going forward. But as we're in this planning process, it's one of the pieces of advice that I've given my clients is like, okay, I really believe that 2021 is a freebie year. We're not going to have any changes that are going to affect 2021 in a huge way, where we've had a couple of changes, like with the unemployment compensation, the PPP not being taxable, things like that, or the credits. But any type of increase in rate will probably not happen until 2022 in the future.
Great, thanks.
Mm-hmm. Okay.
I had a quick question. Any
Sure.
updates on this relates to the state and the sales tax on commercial leases? Has that discussion occurred?
So if I remember correctly, and somebody on this call might know better than I do, several years ago, there was a reduction or a plan to reduce that rate in small increments going forward until it was eventually hopefully eliminated, because as you know, Florida is one of like 2 states, or it might be the only state at this point in time that charges sales tax on commercial real estate. I have not heard that come up for discussion again in the state. I don't think that there's anything out there currently to address that. The state of Florida has a lot of other things to address. One of them is, of course, sales tax on internet sales. They have to pass legislation on that. We're one of the last 3 or 4 states that haven't done that. And in my opinion, that generation of state revenue from just charging sales tax on internet sales would allow them to really reduce the commercial, that sales tax applied to commercial rental. But again, I haven't heard anything recently regarding that. Has somebody else on the call potentially have an update on?
Nadia.
Yeah.
Yeah, let me just, I can chime in a little bit on this.
Sure.
Florida Realtors, this is a top priority for Florida Realtors and has been for probably 5 years. It's frustrating. I know it's frustrating to everybody, especially the commercial members, on this phasing out at these, what seems like small rates. We are the only state in the country that has this sales tax on business rent. Now this year, it is still a top priority for Florida Realtors. I'm not sure if it'll get reduced or not this year, because it's only been being reduced like
0.25. Yeah.
I mean, it's just kind of crazy, but the money is big. I mean, from a budget standpoint, even though it's not big individually, I think it'll continue to be a top priority. They will be pushing it like crazy. We stay on. We hear from public policy staff all the time that this is going to continue to be their priority. Another, and I was going to mention this, but this is another reason that when you see these calls for action or these requests for help from either Florida or the National Association of Realtors, because 1031, mortgage interest reduction, all these things that maybe could be business rent tax, all these things that if you know, to participate in that kind of stuff really helps.
Yeah, absolutely. And well, we won't get into it now, but if you are bored, look up the Supreme Court case of Wayfair. Florida has not addressed Wayfair, and it would be a huge income generator and would be an argument to kind of eliminate that sales tax on commercial rent. But again, we were just kind of behind in this and not addressing these issues in a timely manner. Again, I'm not going to go into PPP a ton, but if you did receive the PPP loan, just remember that that income is not taxable. So it needs to be backed out of your tax return for either 2020 or you can push it to 2021. And then we are allowed to deduct the expenses that you utilize those PPP funds for. And so we were up in the air about this in December, but finally got clarification in January with the new bill that this law change had happened. And then this also applies to the second draw PPP loan. So the second draw PPP loan is still open. You just have to have a 25% decrease in your gross receipts and you can apply for it. And then you have to use your first draw funds before you can get the second draw funds. This application closes March the 31st. The AICPA is trying to get the SBA to extend this, but at this point, the second draw PPP loans close March the 31st. So if you were intending to apply for this, you only have about 3 weeks left to apply for this. The rules are pretty much the same as the first draw. There was a period of time that ended, I think, today. For small businesses, like less than, I can't remember the number of employees to apply, that has ended and the applications are now open for everybody. There's still plenty of money left on the table. I think only 50% of the funds have been utilized at this point. And then the biggest thing is sole proprietors, is that there was a change over the last few weeks in sole proprietors. And as a real estate agent or professional, this could apply to you if you applied for PPP, is that it was previously based on your net income. Well, and if your net income was low for 2019, you could have received a limited amount of the PPP loan, but they've changed the rules and said, hey, you can actually use your gross receipts now. And so as a sole proprietor, as long as you had $100,000 of gross receipts, commissions, whatever that was, you can qualify for the maximum amount of $20,833. and then you could actually add on other wages. But this was a big change that was made very late after most people had probably already applied for the PPP. And as it stands now, the SBA says you can't retroactively go back and change it if you applied in January, February, or the beginning of March. I don't know if that will change, but going forward, this schedule sole proprietors should file based on their gross receipts. So this is pretty big. I'm not going to go into this. This is just the 501c6s are now qualified for PPP. And then the forgiveness application, the simplified application. So this is a big one. If you received a loan, most sole proprietors did receive a loan less than $150,000. The form, you just sign it, confirm that you spin it based on the PPP guidelines, and keep your documentation, but just supply the form and it should be automatically forgiven. And then Daniel, if you want to go through QBI deductions and. Yep.
Yes, thanks, Nadia. I know we're going a little long here, so I'll try to make it quick, but we're going to go over a little bit of some tax advantages, especially for real estate. So the first one is the QBI deduction, so qualified business income. This was passed under the new tax law under Trump when he was president. And this gives you a 20% deduction on qualified business income. And they let rental real estate have this by basically allowing rentals, if they are a trade or business or they meet this safe harbor called the rental real estate enterprise safe harbor, that they can still qualify this. Now, if you make total income over certain limitations, there are certain thresholds. It's 163,000 if you're single, 326 if you're married filing joint. Then the 20% deduction could be limited based on your wages or unadjusted basis and assets. And basically that is like your buildings, your cost basis and your buildings you buy. So this is where basically rental real estate can still get this deduction because most rental real estate doesn't have wages. So if they're getting limited, this allows them to at least have some kind of deduction, even if it's not 20%. Can you move to the next slide, please?
Oh, sorry. Oops.
So next, right here we have is the bonus depreciation. So bonus depreciation lets you take 100% deduction of depreciation in year one of a newer used asset, as long as the life of that asset is under 20 years. And so this is something that just got passed also under the new changes under the Trump law a couple years ago, and this is through 2022. So you get 100% deduction until 2022, and then that is going to get reduced now, I think, back down to 50%. And I'll be interested to see what President Biden decides to do with that, if he decides to extend that or just let it kind of start phasing out. Also, a new thing is qualified.
Daniel, so you had a question?
Okay.
Hey, Daniel, yeah, on the bonus depreciation, 100%, can you retroactively go back to a prior purchase? I mean, a purchase in previous years?
Yes, you can. Now, though, I can't remember the exact date, but it was like 2018. It's like a random date in 2018. So as long as it still falls under those rules, so if you forgot to take 100% bonus in 2019, you can go back and do it. There's you can talk to your CPA about it, but you can basically file a 3115 and retroactively take all that depreciation that you should have taken and stuff like that.
And is that number phased out at a certain income level?
No, there's no phase out, not for the bonus.
Okay.
Okay. So qualified improvement property was another thing that was added, and basically for only commercial properties, but certain improvements, and these are improvements to the interior portion of the building after the date in service that isn't attributable to enlargement of the building, elevators, escalators, or the internal structural framework. So this is like load-bearing walls, basically. Then you will qualify for this qualified improvement property, which makes it 15 years, but then makes it eligible for bonus, so it can get 100% depreciated in year one, which is a great great deduction for real estate.
Yeah. And just a real life example, I have a real estate investor who has a large commercial building in Atlanta, and they did a bunch of tenant improvements that completely qualified for this. And the improvements were in the millions, and we were able to deduct it all this year. So this is huge for commercial property and commercial real estate investors.
Next slide, Nadia. So going off on what we just talked about, I'm going to cost segregations because this works really well with what we just talked about with bonus depreciation and QIP. So basically, this allows real property to be categorized into multiple components that basically allow them to be accelerated depreciation. So this is usually a study done by engineers, okay? But when you combine this with the bonus depreciation we talk about, it can result in large tax write-offs. So when you buy a building, you know, that you're not just buying a 39-year asset and some land. Basically, you have a lot of things in there that are 5 years, 7 years, 15-year assets. And the cost segregation lets you go in there and separate that. So then you can take those at 5 years, 7 years within which you have bonus. And so a lot of times when you get a cost segregation done, you can write off hundreds of thousands of dollars in year one, creating a pretty large tax write-off. Now, do know that cost segregations aren't necessarily cheap, so usually these are for more buildings that are purchased in the $1 million range plus. There is a few alternatives, but that's usually what the price range is for cost segregations. And like I said, study does have to be conducted by qualified engineers. So anyone looking for a cost seg, you can always come talk to us, and we know people that do cost segs in the area. 1031 are like-kind exchanges. Nadia kind of talked a little bit about this, but I'm just going to kind of go over the basics. Basically, you're deferring the gain from your old property you sell into the new property you sell. You must use a qualified intermediary to do this. So basically, you're never allowed to hold the cash. So the cash that you receive from the sale of the property has to be held by this qualified intermediary, and then they use the total amount of cash into the new property. So it has to roll in. When you sell your property, you have 45 days to identify the purchase of a new property, and you have 180 days to close it. And then we kind of talked about, does this still make sense in today or in the future? You know, it all kind of depends on potentially, you know, what could happen with the potential President Biden tax law change or anything like that. Obviously, currently, and like Nadia was saying, in 2021, we don't expect any changes. It still makes a lot of sense. And the tax strategy of swap till you drop, which is basically keep doing a 1031 exchange until you pass away, and then you pass it on to your beneficiaries and they get step-up basis, and basically you permanently eliminating any tax is a great tax strategy if that's something that you want to create wealth inside your family. We'll see how that goes in the future, but right now it's still very viable. But obviously with the 1031 exchanges, which I don't know if in the future they'll actually touch that. It's just such a great real estate advantage strategy. But if they do touch the step-up basis, that could completely change how that strategy works. Did you have anything to add on that, Nadia?
Nope, I'm good.
Good. All right. Next slide. So we talked about making the new bill just made the 179D energy efficient tax deduction permanent. So this lets business owners or designers, so this architects and engineers, claim tax deductions for installing qualified energy efficient systems in buildings. And the deductions take in the year the building's placed in service. So if it takes several years to build the building, it's in the year it's in service. And so this is a really great deduction, especially since most buildings built today are usually some form of energy efficient. And this is for like commercial and government buildings. And some of our clients have had taken some really, really nice deductions using this. Nadia also mentioned interest rates. You're in real estate, you know about interest rates, and you're keeping an eye on interest rates. At its historic lows, it's just so cheap to borrow money. And you can basically use that leverage to increase your rate of return. And then the greatest thing about fixed rates is it's basically the #1 way to combat inflation. So basically, even though the inflation goes up, your payment stays the same. And so over time, you're basically using technically less money to pay for your fixed rate on it. So great tax advantage against inflation, especially if you're expecting a lot of inflation in the future, which could be because we're printing a lot of money and there's a lot of quantitative easing going on. So if you can get that fixed rate today, it might be a great advantage for you in the future. Questions?
Nadia, you referenced some possible change to the SALT deductions,
Yes.
but I kind of didn't catch the rest of that followed. What was your point?
So currently what the laws that we have are that if you itemize on your tax return that you are limited to a $10,000 deduction for real estate. And this came about through the TCJA Act under Trump. And it was to balance the budget, to kind of create some limitations to fund other parts of the tax code at that point in time. So under Florida law, we don't have an income tax. And so that really affects real estate in the state of Florida. And so if you have investment property, let's say that you potentially don't hold through an LLC or an S Corp or whatever it is, and that this is your vacation home, your personal home, your second vacation home, some lots that you're sitting on, you are subject to the limitation of $10,000 deduction on your Schedule A for that property. A lot of states have been fighting this. Florida, again, doesn't have that state income tax, but let's take the state of New York or the state of California, who has a pretty large income tax. And their constituents are limited not only in real estate, but in state income tax to that $10,000 cap. And they are lobbying pretty hard for that to be eliminated under the Biden administration. And so if that is eliminated, it would release the cap in the state of Florida, and you could then deduct 100% of your real estate taxes. So that's the SALT cap that we currently have for real estate. Most people it doesn't affect, but if you have a high value home and you're paying more than $10,000 in real estate taxes plus your vacation home, you could really be subject to those limitations and lose a deduction.
And do you see that being phased out on in some type of income basis?
It just potentially, yes, because Biden wants to phase out all itemized deductions for anybody making over a certain threshold. So if he reinstitutes it for everybody, he could do that and phase out total itemized deduction. So I could definitely see that happening.
Thanks.
Mm-hmm. A lot of unknowns in the future, but we just take them one by one and plan around them, and to be aware of them and make sure that we know what's coming down the pipeline and make the decisions today, to kind of help your clients or your specific business.
Yeah, Daniel, Nadia, thank you guys very much. I did want to make a comment that you referred to. This was done in an effort to balance the budget, like going back, and I'm like, I think that was a fail then, because I don't think they ever, at least my recollection of what's gone on in the past, I don't know, 25 years or whatever it's been.
Well, and just to clarify on that, maybe not to balance the budget, but to balance the impact of that bill. And so it has to be a balancing effect in the bill itself, which is, I don't understand all the nuances, but I know that it ties their hands in some situations. So
I was going to say the budget hasn't been balanced since Clinton, so it's been a lot of presidents.
That's right. That's right. If that was very informative, and again, we're recording this, and so we'll post it once we have the recording. I did want to remind you, because I mentioned this because it seemed like a good time, but pay attention to what's going on with the National Association and Florida Association, because those entities, those public policy professionals will be asking for help from realtors. And if you can send a call, if you can respond to the call to action, I mean, that's truly helpful. They do count noses. So, Stuart, do you have any?
I was just going to say, great information. Appreciate your time, Nadia and Daniel. And with the unknowns of what's coming down the pipe over the next couple of years, it sounds like maybe we should revisit this this group in 9 or 12 months and see where we stand.
Absolutely.
And I think, Stephen, if that's it, we're 3 minutes over time, and appreciate everybody tuning in. If you have any follow-up questions, shoot them to me or Stephen, and we'll get you some feedback on that.
Thanks, Daniel. Thanks, Nadia. It's great.
Thank you so much.
Thank y'all. Bye-bye.